Well, hello, Get Rich Education Nation. I'd like to welcome a longtime friend onto the show. She's been helping you obtain mortgage loans for a really long time. She is the president of Ridge Lending Group. Her name's Caeli Ridge. Caeli, welcome.
Hey, Keith. I'm very happy to be here today.
Yeah, it's so good to have you back here. You've really been helping our followers for quite a long time. As we know, wealth is built through leverage more so than compound interest. Leverage comes through loans. So it's really key and really critical because here, Caeli, at this time, it seems like we have all these, I guess, extremes in the market. We have higher prices, historically low mortgage interest rates, and perhaps what's most chronic is that incredibly low supply. This is all driving higher demand, and what this has done actually is it's made a lot of people want to pay all cash for properties at times when they can, which is kind of silly when you think about how low mortgage interest rates are. Why would anyone do that? But interestingly, one of the things that's happened in the marketplace, Caeli, is when someone pays all cash, they don't need to get an appraisal. Appraisal basically being that tool where the bank checks the quality of their collateral. So we talk about qualifying for a loan. A property needs to appraise for that sale price. You deal a lot in income property. So what can you tell us about the appraisal environment, especially with a lot of these all cash offers coming in for properties? What has that done to appraisals?
Yeah, so I did a little bit of research about this before our call, Keith, and I took kind of a sampling all over the United States. Obviously, we do loans almost everywhere. But I talked to probably half a dozen appraisers, and without exception, all of them said that the cash acquisition wasn't necessarily impacting how the valuation within the appraisal network performs. What they did tell me is that they're noticing because of the lack of inventory and things there, and also one of the bigger comments that I heard was that the MLS, where they go to find their comps used to evaluate or to create that baseline valuation, Zillow and Redfin, places like that that have their own real estate channel, is where they're actually having to start looking to for getting reasonable comps so that the values can meet the purchase prices, right? I mean, a lot of times I think in our industry, and I'm guilty of this too, we kind of are hard on our appraisers when the values come in low or they don't give us what we want.
Sure.
We assume that they're somehow not justified in the valuation when all of them actually were able to say that absolutely they want the values to come in at the purchase prices. They do everything they can within the confines of their regulation to get us there. But it was surprising to me that a lot of times the MLS is not as up to date. So they're going into the multiple listing service, which is where all of the recorded closings are going to be found, all the different data points, the purchase price, the square footage, the bedroom, bathroom count, all of that's going to be listed there, the dates and things. But it's behind the times. The MLS recording system is not giving them the appropriate information. They've actually had to go into these Redfins and these Zillow platforms to go ahead and get where the real-time sales are to support some of those values. So that was one of the biggest takeaways for me. The other thing that I heard more than once was some of them are feeling like, at least on the conventional side of mortgage lending, right? What we're talking about here today is that the individual appraiser may be a thing of the past in the next couple of years. A lot of automation. There's something called collateral underwriting. I won't get too technical about that, but collateral underwriting might ultimately replace an individual and have appraisers for what we do be totally automated. We'll see. That's, we've got a couple of years for that, but that's something that many of them commented on.
She said so many interesting things there. One of them is the fact that appraisers are potentially looking at sources like Redfin and like Zillow. Zillow and their estimates seem to be the butt of jokes just 5 or 10 years ago. So it's remarkable that in this day and age, it's possible that they could be steering appraisals. Well, Caeli, as people look to qualify for more income property, and you're such an expert there because there you do help people qualify specifically for income property. A question that a lot of people have is, now wait, when I add a new income property, how does that affect my DTI? So to get into buying a rental property in the first place, generally that underwriter there at your office is going to go ahead and look at one's debt to income ratio. That prospective borrower's ratio of all of their monthly debts, say that's $4,000 in minimum payments, divided by their income, say that's $10,000 per month. That's a DTI of 40%. However, then when one goes and buys an income property, well, that income property has certain income and expenses associated with that. So really the question a lot of people have as you're looking to build your real estate portfolio is, how does that DTI get affected over time as I continue to add rental properties into the equation?
So it's such a good question, and it's such an important question of
Yeah.
all the different characteristics and criteria to qualify for an institutional loan. I think it's the debt to income ratio well above assets or credit that really should be understood by the individual. I want to just take this in two parts, Keith. The first thing that you had mentioned in your example, $4,000 of total monthly debt as minimum payments divided by $10,000 of income. I want to clarify the debts that are included in a DTI or debt to income ratio calculation are going to be those monthly payments found exclusively, well, almost exclusively, I'll define almost in a minute, but found exclusively on the credit report. The almost in that sentence is equivalent to three things. If you are a renter, right? If your primary housing is a rental unit, you're not going to find that amount on the credit report, but we have to include that in the DTI. So that would be one. HOA dues on any property, also not on the credit report, have to be in there. And then finally, any taxes and insurance that are paid separate from a mortgage payment have to be added in there. The rest of the monthly liabilities that we will include in a DTI calculation will exclusively be on that credit report. And the reason I want to make a point to go over this is that a lot of people mistakenly assume that ordinary living expenses apply. Food, gas, utilities, cell phone bills, entertainment, right? Those do not play a factor. So just to clarify that point. Now, let's talk about debt to income ratio as it relates to investment property acquisition. Now, this gets a little bit convoluted. I'm going to keep it really simple. There are two ways in underwriting that we will calculate rental income to potentially offset the new mortgage payment, PITI, principal, interest, taxes, and insurance of this investment. The first way is called the acquisition year. This is equal to the day in which you acquire the property and up until the property falls on that year's tax return, specifically the Schedule E of that year's tax return. And then the second formula is called the Schedule E formula. Once the property does fall on that recorded federal tax return Schedule E, the formula changes. I'm going to abbreviate the Schedule E in just a second. I want to focus on the acquisition year formula. This is extremely simple to follow, and it will help, I think, all the listeners here really understand what can be used and what can't be used when we are recalculating debt to income ratio to include this new purchase. Okay, get a pen and paper ready, people. Okay, this is easy. In the acquisition year formula, we are going to give you 75% of the gross rents, the proposed gross rents, because remember, on a purchase, more often than not, you're not going to have a lease, right? It's not going to get leased until after the fact.
Right.
So we're going to use the appraisal of an investment property, which will give us a median. It's an additional form on an investment property appraisal, a median of what the gross rents for that type of property in that neighborhood would go for. Those are public records. So we're going to take the gross rents, whether a lease or the appraisal, whichever one is applicable, and we're going to give you 75% of that number. So let's say, as an example, the gross rents are $1,000 a month. 75% of $1,000, $750 of income that you get to use for this property. From that, we're going to subtract the proposed PITI, principal, interest, tax, and insurance, and whatever the end value is there is what we will count as income or liability. So let's take my example again, $1,000 of gross rents, but let's say that the PITI here is $500 a month. So 75% of $1,000, we have $750. From that $750, I'm going to subtract $500 of your new total mortgage payment. In this scenario, we have a $250 gain, right? It's a positive number. I'm going to take this positive $250 and I'm going to add it to the income column when I recalculate DTI to include this property. So I want everyone to stop and think about this for a second. This is a pretty big deal.
It's me, the video editor. This is Matthew Blunt, the content manager at GRE, and Caeli's content here is so good and important. I just couldn't skip the opportunity to highlight it even more. So what she said is this is a big deal. Over here on the right, this is what Caeli does. She takes the rent, subtracts the expenses, and the difference she adds to your income. In this case, if you were to do it separately and add the mortgage to your debt side and add the full 750 to the income side, it actually worsens your debt to income ratio. And that's why it's such a big deal. The order in which this is done, the way Caeli does it, very investor friendly. So we should all be thanking Caeli because that's really great. Don't forget to like, subscribe, and hit the notification bell.
Your debt to income ratio, right? So the $500 PITI is covered. It's totally gone. It's handled. We have $250 more in income than when you started, right? So as a result, your debt to income ratio in this example is lower now than it was before we even started talking. It's pretty cool, right?
Yeah, that's interesting because that in that example, what would flow to your DTI calculation for your next property is $250 of income and no debt.
Correct. Now, one caveat to that, at acquisition during the purchase of this property, right? I said I didn't need a lease, I could use the appraisal. Once you are officially the owner of this property, right, and you're now looking to purchase your second, for example, I must have a lease to give you that 250 to offset that mortgage. Until the lease is in place, I'd have to hit them for the entire mortgage payment until we actually have the lease post-purchase.
Ah, got it. That is an excellent explanation. And it also shows a prospective borrower that that's different than your cash flow, that $250, because that DTI calculation excluded things like maintenance costs, for example, or property management costs.
Right, and that just so it kind of paints the better picture, connects the dots. The vacancy and maintenance is equivalent to that 25%, we call it vacancy, that we're not giving them credit for. So that's where that comes from. I would say one other thing for the people that are listening, and this is something I can say with a good amount of confidence, the acquisition year formula will always produce a positive number, at least as we exist in this current real estate cycle, right? Real estate, like any investment, is going to be cyclical, but I can tell you guys that from the 0809 housing and lending debacle to now, I have run that calculation, 75% of the gross rents minus the PITI. I can't even count, tens and thousands of times. I've never seen it produce a negative number. Now, whether it's $1 positive or 250 to my example, acquisition year is our friend. It will always be to our advantage. There are some other conditions in there. I'm not going to get into those. They're more individual based, but that's acquisition year. I'll quickly go into the Schedule E and only say that the Schedule E calculation is such that to articulate it verbally is only going to confuse us all. I'm going to tell you that on a per individual basis, looking at the Schedule E together and actually going through an exercise that shows the individual, and this is what we're really known for, is the education that we provide for our investors. But looking at the Schedule E along with a worksheet, pre-formulated worksheet that will show you the ones and zeros, what we can take from the Schedule E, what we can use, what we can back out, what we can add in, those different things. Schedule E is complicated, and I would finalize that part of the explanation by saying that more often than not, the acquisition year is going to be a positive number. The Schedule E will generally be a negative number, at least for the first few years of ownership until the property has stabilized. Okay, now, negative number to what degree? $50, $100, $200. It really depends on a whole variety of variables. Again, I'm not going to get into for this show, but it's a lot more ominous than just the acquisition year. So I think the bottom line comment here is that one of the ways you can optimize debt to income ratio is look at what your capabilities are from one year to the next, and really when you file your tax return. And this is an important final thought here. If you purchased a property in January of 2021, okay, and you know for sure normally that you're going to file your tax return for this year, April 15th of 2022, just know that as soon as that tax return is filed, that's when the Schedule E will start to be applicable in underwriting. We might give you advice that says, maybe we want to file an extension for 2021 and simply buy us more time. Now we have until October of next year to use that more favorable formula. And those are, again, all the things that I think that Ridge really has some value adds with in the education that we provide our investors.
That's a great example of how you help people plan and see ahead. This is really the architecture of building a real estate investing portfolio. And Caeli, really a common question when someone's looking to build their portfolio is how many of what we call golden ticket loans can I get? Those conventional loans at the best interest rates and terms. Historically, that's been that one individual can get up to 10 finance properties, including the primary residence, or 20 if they're married. Are we still at those levels?
Absolutely, 10 per qualified individual. I would say one thing, and yes, a lot of times when we have couples come to us, that's one of the first things that we tell them because they're not aware. If they were to apply jointly, now they have 10 golden tickets between them, but if we can get them to qualify, whether today or teach them how to qualify next month or next year as part of the plan, now they've opened up to 20. I would also mention too, that for those that don't necessarily have a primary residence yet, we do have lots of clients that will go ahead and maximize all 10 of those conventional loans for investment properties exclusively. And then property number 11, they may make their primary because there is no guideline or limit to how many finance properties you can have when we're talking about a primary residence. You could have 50 finance properties and still qualify if your qualifications are met for your owner occupied. That 10 limit max only applies to investment.
That's another great planning consideration. And generally, when Caeli and I are talking here about up to 10 properties, single or 20 married for conventional loans, understand that we're talking about income single-family homes up to fourplexes.
Correct.
Caeli, one interesting news item is our 40-year mortgage is coming. This has made more headlines in the real estate world lately. And if I could just add some commentary, I find this really interesting. I don't know that this is the right time for this in the housing market because what this does is lower payments when one can stretch their amortization from 30 years over 40 years. So that basically makes housing somewhat more affordable for people and increases demand even greater, whereas we really need more help here on the supply side, not to the demand side. But in any case, can you tell us more about your thoughts on our 40-year mortgages really coming?
So I've heard a little bit of rumbling myself. I don't think that we're in a place where that's going to be reality for the next year or two. I just don't see that happening. Interest-only loans are, I think, going to be more available to start with than the 40-year amortization. And remember, the longer the amortization, the higher the interest rate. So a 15-year is going to have a lower interest rate than a 30-year. A 40-year is going to have a higher interest rate than a 30-year. But it is, you're right, that amortization that stretches out the payment over that longer period of time, that even though the rate is higher, the payment is going to be lower. I love a longer amortization, right? I am all for it. Accelerating payoff should you choose to. Let's say, for example, let's just use the 15 to 30 because those are the common ones. A lot of people come to me and say, hey, I want a 15-year fixed mortgage. I'm going to do everything I can to try and talk them out of that because the 30-year, while it is a higher interest rate, is really going to optimize their debt to income ratio. It keeps that payment on paper much, much lower. If they really want to accelerate and pay off in 15 years, it's extremely simple. Looking at an amortization table and figuring out the principal and interest payment between a 15 and a 30. Let's say it's $500 a month, just for a round number. Take the $500 a month, apply it with your 30-year fixed payment. You'll cross the finish line, and I think it's like 15.5 years. So you do pay a few extra months of interest. However, you've accelerated the payoff so quickly, you never end up paying the higher interest that the 30-year has. I'm going off on a tangent, aren't I? This is kind of a popular topic. But you've kept your payment lower and your debt to income ratio in better care. So I love the 40 years. So for anybody listening, if it does come back that says, oh, I don't want to stretch it out over 40 years, you don't have to, but it would be a vehicle or a tool that I would recommend that can help lower the DTI. If it comes back, when it comes back, I think that's a great option. Otherwise, I do think that interest only may be the first to arrive if we were to see some of those products come back.
Interesting.
The problem with the interest only, though, I think, is that the rates on interest only, at least for the initial onset of the release of this, are going to be high enough that it offsets, meaning, let's say you can get a 4% interest rate on a 30-year fix today versus a 6% interest only. you're going to have to do the math. It may not make sense to take that interest only if it's not, substantial enough in savings. But I would start looking at, especially for investment. Now, maybe we see something that comes out for an owner occupied in the 40-year range, but for non-owner occupied, I think we've got a good year or two before any of that starts rolling back out.
I'm quick to remind people that shorter loan terms, like a 15 as opposed to a 30, what that really does in your investor life is convert your cash flow into equity. Financial freedom is created by converting equity into cash flow conversely. So if interest rates are the same, the interest only actually makes the most sense when one understands and believes that. But you do bring up another good point about the aforementioned DTI. And when you do get a longer amortization period, that does help your DTI because it reduces your minimum payment and it gives you more flexibility, like you said. Well, Caeli, how many states do you offer loans in? And I know we're talking about the states where the property resides, not where the borrower resides. Tell us about that.
Yeah, I'm excited to announce that we're getting closer to reaching the 50. We're in all but 5. Let's see if I can get these by memory. Alaska, unfortunately, Keith, sorry. Alaska, your hometown. Alaska, Maine, North Dakota, New York, and Vermont. Otherwise, we are everywhere in the U.S. funding investor loans.
A lot of those Northerners, Yankees, are out of luck. Well, over the 6 years, you've done more loans for Get Rich Education followers than anyone ever since we learned about you. In fact, Ridge, your company, it's where I got my last few income property loans and where I did my last few refinancings. I'm a believer. And, a lot of these planning things that you talked about here, like, for example, structuring things with regard to your DTI over time, are really where that's helped me by going with a specific income property lender like you. So if someone wants to get started, what's the best way for them to do that, Caeli?
Well, there's lots of different ways they can reach us. Our website is a great resource, ridgelendinggroup.com. They can call us toll free at 855-747-4343. An easy way to remember that is 855-74-RIDGE, or they can simply email us at info@ridgelendinggroup.com.
Well, Caeli, people often hang on every word that you say. You've been doing this for about 2 decades. You've helped more families create financial freedom through real estate investing than any other lender in the nation. It's been great to have your insight here as always. Thanks so much for coming on and helping us out.
Thanks, Keith.